Hello and welcome to Switzer Investing Insights, brought to you by NAB Trade. And with interest rates on the way down, the really important question is, how about investing in fixed interest on the ASX, and how do you do it? So Paul, let's take us through the key considerations that people should be thinking about.
Yeah, I want to come back to the types of fixed interest investments in a moment, Peter, but let's talk about what are the underlying or things you really should think about when you choose a fixed income investment. The first thing and the most important thing are what are the physical assets behind the investment? What are the type of bonds that you're investing in? Are they, for example, issued by governments, in which case they're secure, or corporates, not as secure? Investment grade or non-investment grade? What's the expected default rate? And how easy are they to realise? Sometimes assets sound like they're really easy to realise, for example, mortgages, but if you invest in a mortgage fund, when they want to actually sell someone out of a house, it's a lot harder than it looks. So that's an important question. The duration of those assets, in other words, the term, typically, the longer the asset, the higher interest rate it pays. The shorter the asset, the quicker it is to maturity, the lower the interest rate. So the term of those assets is important.
And with rates so low, long-term durations are a bit of a worry, aren't they?
They are a bit of a duration, and that arguably increases your risk as well. How well diversified is the product is important. The type of return you're getting, does it actually, is it worth the risk you're taking to get that sort of return? So I describe as the adequacy of the return for the risk. The manager, their style, experience, track record, the fees you'll be paying. And of course, finally, if it's an investment product like a fund, how liquid is that fund if you want to get out?
Okay, let's start talking about the kind of products you'd be considering.
Look, there are actually a range of fixed income investments available on the ASX. The first one are traditional government bonds. So this is the way the Commonwealth government funds its budget deficit. Both the normal type of bond, there are also some index bonds. Don't get excited by the yields because the current 10-year government bond, Peter, is under 1.5%.
They're super safe, but they're really low.
Super safe, so don't get too excited. There are also what we call exchange traded bonds, or XTBs. These are sort of units in underlying corporate bonds with 43 different series. When you've got issuers, for example, from AGL to BHP to some of the banks. So this is like buying a corporate bond, but effectively through just a synthetic bond unit called an XTB, traded on the ASX. The bonds are typically around about 3 to 5 years. Again, yields have come down. They're in the 2s. There are some higher issues with a slightly lower credit rating, which you can get a 3, but rates have come down and yields have come down.
Because corporate bond rates used to be a little bit more attractive, weren't they?
They did, and these are generally pretty good corporate bonds. Most of these are investment grade, Peter. So
big names.
And some names that you'll recognise. Yeah. Another way to invest, of course, is you can invest in the so-called exchange-traded funds. So these have been around for many years, and these track underlying fixed income indices, and of course they invest according to the index. So there's an index that tracks all the Australian government bonds. There's an index that tracks the semi-government bonds issued by the states. There's an index tracking corporate bonds issued by most of the major issuers. So these track various indices. Probably the better-known one is Vanguard, which tracks all of them. It's got a ASX code of VAF. iShares, of course, and Beta Shares have also got products. And you can not just do onshore, you can also do offshore. So there's a plethora of fixed income opportunities.
Okay, they're the index ETF types. What about the actively managed ones?
Yeah, so we have actively managed funds from some of the leading global fixed income managers. They're available through M funds. You can access M funds directly through NAB Trade as well. Huge global managers like PIMCO has many fixed income funds. You've got Australian managers like AMP and Smarter Money, other managers like Legg Mason. So that's a way to get it to the plethora of fixed income that's available through those actively managed funds.
And while in the stock market, you've got listed investment companies.
And then finally, we've got a bit of speciality through some of the listed investment companies. These are essentially investing sort of higher risk, up the spectrum a little bit, and where they're really trying to get a decent return or quite a high return in relative sense for their shareholders. Metrics Credit Partners has the Master Income Trust. We've got the NB Global Corporate Income Trust and some others on the screen there.
All right, Paul, why don't we look at the Neuberger Berman Investment Trust?
Yeah, so this invests in global high-yield bonds, Peter. So these are large and liquid companies, but they're not investment grade. So they're in the lower credit category. They're diversified by industry and country and credit grade, and about 60% are going to be the issuers are domiciled in the USA, 20% in Europe, and 20% in emerging markets. Yep. 250 to 350 different bonds, so it's very diversified, which is to sort of, really
not too much dependence on any one company.
Not too much dependence on any one company.
Yeah, right.
Now, because they're investing in high yield bonds, they're targeting a monthly distribution to shareholders of about 5.25%. Now, they've been paying that, so if you're a shareholder, that's what you would expect as a monthly income. That's not guaranteed, of course. No. Plus, they also are looking for an attractive total return through a full market cycle. So that means the ups and downs of the credit market cycle.
Yeah. And they've been hitting Australia for quite some time with the big end of town, big institutions, but this NBI ticker code offering on the stock market is actually for smaller investors.
Yes, so Neuberger Berman, they're a global manager. As you said, they've been looking at some wholesale funds in Australia. They're now provided this effectively a retail product. It operates through a listed investment company structure, trades on the ASX under the stock code of NBI, and the market cap will be around $800 million. So one way to access sort of the global high yield bond market.
And the important point, Paul, is that really safe bonds are really low interest rates at the moment. As you go up and start chasing return, you do add to risk, don't you?
Well, I think what the markets are telling you is they're expecting interest rates to go lower. That's why we've got a 10-year government bond rate of below 1.5%. So the cash rate is expected to fall further. It doesn't mean it will, but that's what the expectation is.
Yeah.
That's why bond yields are as low as they are. And of course, as you try to increase your return, you're taking on higher risk. And it's the usual sort of axiom, higher the return, the higher the expected risk.
Exactly. That's Switzer Investing Insights brought to you by NAB Trade. Thanks for joining us.